Money brings happiness. Even if it doesn't for some, the fact that it does bring comfort and relaxation to those who have it cannot be denied. Investing in stocks is a sure way to rake some cash into your own pockets, but it doesn't come as easily as breathing in the beginning. This video will show you how to invest right from the very basic steps up to the techniques to hone in this field. In just a few minutes, with a click of the like and subscribe buttons, you'll be on your way to becoming an investing master. Earning money in the comfort of your own home or even as you are out in the mall is one of the most desired sources of income for many individuals. No more getting stuck in traffic and running late to your work as money is being earned passively. This is made possible through investing in stocks because the stock market is a security that represents a fraction of a business that is given to you as an owner. Owning stock in huge companies such as Coca-Cola with over 100 branches and factories worldwide means that you're also an owner of the company, albeit being only among many others. But this could still give you an ample source of passive income without going to work. To acquire a stock, you need to sign up for a brokerage company that allows you to buy and sell stocks. It's important to select companies that are well known and have clean records. If your budget is low, Robinhood and Webull offer free trade for low fees, and if you have a slightly open budget, check out Charles Schwab, Fidelity Investments, or TD Ameritrade, which have been around the market for a couple of years and have established their name. Choosing which company to buy stocks from is as easy as searching their website on Google and filling out forms. The difficult part comes in deciding on where to invest in. Yes, an investor should be knowledgeable of the companies that are rising or falling in the current economy these days. But some decide too quickly, making them lose money without being properly educated on the norms of this field. There are 4 investing styles that I'd like you to choose from, depending on whichever you feel is the most comfortable for you as an investor. But before I proceed, what companies do you think are those leading in stocks right now? We all know that the stock market changes every minute and it's keeping everyone on their toes. Some become a million richer while others a million poorer as the clock ticks. By the way, don't forget to hit the like and subscribe button as we move on to the next part of the video. So there are 4 investing styles I'm going to show you in this video. 1 is value investing. 2 is dividend investing. 3 is a laid-back style that will do you good in the long term called index fund investing. And the last one is growth investing, popularized by Cathie Wood. Value investing made Warren Buffett into a billionaire. Now, this may sound easy, but it definitely isn't. However, it can yield very high returns if researched and done right. This style involves buying stocks at a very low price, which basically is a gamble, as you need to observe very precise timing when to buy cheap and sell high. Oftentimes, investors fail to do so because once the price goes down for a business, its values go down as well. Buffett started making money when he was younger as he diligently went looking for bargains that have high value for low prices. Looking for the PE, or the price to earnings ratio, is the key to investing in this style. If the number of that company's PE ratio is proportional to that of its value, a low ratio means that it's cheap, and a high number means that the price is expensive. Alibaba is a prime example for value stocks, and another one is Berkshire Hathaway Incorporated, in which Buffett is the head investor. Dividend investing is a safe approach for those seeking guaranteed passive income, which is given in quarterly or monthly dividends. It's a style where the investor buys stocks as a portion of their earnings and then the passive income normally comes depending on the company. However, you as an investor shouldn't just go placing your money on every dividend investing you could get your hands on. It's important to understand the numbers behind the stock. The Coca-Cola Corporation yields a dividend of $68, which gives it a dividend yield of 2.86%, which isn't bad. If $100 worth of stock is bought, an annual income would be 2.86%, which is not bad at all. Next to look out for is the payout ratio. This is the proportion of earnings a company pays in the form of dividends and how much is reinvested in the business. Another one to look at is the company's earnings for the past few years. For example, you can look at a company that yielded a trend of going higher and higher up until the world was hit with the pandemic in the year 2020, in which case it automatically decreased the income of the company, and on that note, all companies all around the globe. Lastly, in buying a dividend stock, the investor should look into the history of the company, if they were able to pay off dividends consistently to their shareholders or not. The Coca-Cola Corporation is a classic and popular dividend investing company because it's established its name on the market for the past few years and will hopefully continue to do so in the future. Dividend investing is surely the must pick if the investor wants a reliable source of passive income, but this is not the right one for those who want to have quick growth room, as this is more on the safe side of investing. Money definitely doesn't fall from trees. If it did, then you and I probably wouldn't even be here right now. However, investing in the stock market is becoming similar to that as our market continues to evolve. Do you already have an investing technique that piqued your interest? If not, continue on with the video, but don't forget to like and subscribe before you proceed. The third investing style for this video is for those who don't have the time or just don't want to spend hours and hours on research and analysis of stocks. This technique is called passive investing in an index fund. This is truly an interesting way to invest as it beats most of the returns that big hedge funds get. This is why billionaire Warren Buffett also recommends it to other investors. Technically speaking, an index fund is a basket of stocks that tracks a specific group of the market. An example of this is the SP 500 index fund, which houses over 500 large stocks that track the American stock market. It may sound too pleasing for it to be true, but when it comes to investing, sometimes it's better to appreciate that there's a bigger gain in betting less. In this investing technique, you need not delve very deep into the schematic of things, just the very basics, and it would do you better not to wait around too much. Just let the cash flow passively over time. Cathie Wood is the prime example of a good investor for our last investing style, which is growth investment. And for over 7 years, she's averaged an annual return of 39%, which is 3 times the return of SP 500. This investing style, if done right, can multiply your money in just a short span of time. Although this investing style has more risk association in comparison to the others, it's important that the investor studies where the business is heading into the future. It's a play on taking a risk by believing in products and companies that you're interested in to flourish. Along with this, the investor should also look into the revenue of the company because what use is there for a popular business if it would not make money in the long run? Industries that may prosper in the future may include robotics, automation, artificial intelligence, and blockchain companies. A more popular name in this field is Elon Musk with his growth investment in self-driving cars. Tesla is expected to rise more in stocks as years pass by. Investing is not a foreign field anymore as it's been continuous in its development. You, as an aspiring investor, should get into the game beginning with a small amount of money to test the waters first and then learn as you go. What's the worst that could happen? Surely there may be occasional mistakes here and there, but with the continued participation and expansion of your stock knowledge, everything will fall right into its place. What's a master if not a student first? Well, I hope that you gained a drive to delve into the stock market after watching this video. Once again, don't forget to hit the like and subscribe button. Till the next vid.